want to say that. All right, so, okay, we're definitely going to go through a couple of these things that we don't need to. All right, so when we're looking at transactions that happen within a company, we have external events and we have internal events. The external ones are the ones that are involving the assets and liabilities and that we can see between a company and somebody else, whereas the internal ones only happen from within a company and usually involve some type of asset or product or inventory. We're focusing on those external changes, external events. So we're going to start looking at how we analyze, record, and then summarize these transactions. And the first thing that you want to remember, basically memorize, is that every transaction has at least two effects on the accounting equation. And remember, the accounting equation is assets equal liabilities plus stockholders' equity. Okay? So that always has to balance. Right? Assets always must equal liabilities plus stockholders' equity. Every transaction has at least two effects, which means there has to be at least two things happening. It could have more than that, but it has to have at least two things happening, and it always has to balance. So as we go through this, that's what we're looking for. So the first thing we're going to do is we're going to analyze each transaction. And one of the things, not so much a big worry anymore, is there's a thing called a chart of accounts. Every account that we're using is in this chart of accounts. Every company has their own chart of accounts. In companies that now use computers, which is almost all of them, those account numbers and names just pop up for us. And every account has a unique number. So the first thing you do when you analyze a transaction is you go through and you look to see, did something actually take place? So in this transaction, it says that the company issues stock to Jordan and Ty as evidence as their contribution of $10,000. So if Jordan incorporated this company called Noodlecakes, and they were given $10,000 cash, did something take place to that company? Did a transaction actually take place? Did an event take place? So the question is, did two things happen? Well, one, their cash went up. They got cash. And two, they issued stock. So yes, a transaction took place. And the way we look at this transaction is cash went up and common stock went up. So that's how we know something. We received something and we gave something away. If we didn't receive or give something, then a transaction didn't happen. So that's how we're analyzing these transactions right now. So if Noodlecake paid $300 cash to create a logo, did a transaction take place? What do you think? Yeah. And so in this case, we paid $300. So cash is going to go down. What is a logo? Okay.
Proprietary asset.
All right, there we go. Proprietary asset. So logo is going to go up. Now, those are both on the same side, assets equal liabilities plus stockholders' equity. So is that okay? Do we still balance? Yeah, we do. So that is okay. It looks just like that, but it's typed up and not in my beautiful writing. All right, now Noodlecake borrowed $20,000 from the bank and deposited those into an account and gave them a formal agreement to pay in 2 years. So is that accounts payable or notes payable? We had notes payable, right. We got two things going on. One, it says 2 years, and two, it said or formal agreement to pay. You can almost guarantee if it's a loan from the bank, it's going to be a notes payable. All right. So this one is going to be increase cash and increase liabilities. That way both sides are equal. Liability went up and cash went up. All right, now we bought equipment and we promised to pay them at the end of the month. This time it's what? Not notes payable, this time it's
Accounts payable.
yes, exactly. So both accounts go up. Now we paid back the supplier that we borrowed the money from in the prior step. We only paid them $5,000 of the $9,600, but we paid them back. So if we're paying them, what account is decreasing?
Cash.
Cash, exactly. And the other account that's actually going to go down is what happened in step D, if you can remember. We owed somebody money, so step D looked like this. Now we're paying them back. So we're going to do that. We're going to decrease accounts payable. So it will look like this. Because the step before we had increased it. Does that make sense? Okay, you guys were a little quieter. Okay, I think there's two more. Noodlecake signed a contract with a programmer for a game called Tiny Warriors for a game up of $9,000. No code has been received yet. What would we do?
That's an interesting one.
Yes.
Would that be a lot of dollars? Is that a transaction that they signed, but they didn't do it yet?
They didn't do it yet, did they? And did they get the money yet?
Nope.
Nope. They didn't get the money, and they didn't do it. So one thing you'll find in this class is there's a difference between financial liability and legal liability. So while Noodlecake might be legally liable for that money, it doesn't go on the financial statements until it's a financial transaction. And so nothing has been paid and nothing has been received, so therefore it does not go on the financial statements, even though they might legally be responsible. So they just signed a contract, nothing goes on the financial statements. So it looks like that. Absolutely nothing. Now they received the game and they paid $4,000 in cash and they promised to pay $5,000 next month.
Accounts payable.
Okay, accounts payable for how much?
The $5,000.
The $5,000, yeah. So it's going to be, I'll write this one. So accounts payable is going to go up by $5,000. What else is happening?
The cash went down.
Yep, cash is going to go down by $4,000. And what's the last thing? What did we get?
I was going to say something happened because I got the game.
Yeah, we'll call it app. I don't know what we want to call it. And that's going to go up by 9. So do we still balance on each side?
Yes.
Yeah, we still do.
Oh, yeah.
Okay, you see it? Yeah, we still balance. So we can have, remember we have to have at least 2, but we could have 3 or 4 different things going on our transaction-wise to different accounts, as long as we have at least 2 and we still balance in the end. So we still got the 5,000. And then the last one is Noodlecake received supplies of $600 on account. So what did we get? We got $600 of supplies.
Okay. Down 600.
And then accounts payable, 600. Not cash. I think someone said cash. Accounts payable. Yep. All right. And then you end up with this wonderful little, if you were doing this in Excel, it would look like this on a spreadsheet. And then we keep on trucking to what we would then do to the next thing. So let's look at a problem. So go to your working papers again. Let me pull those guys up. Chapter 2, which should be shortly after. Because we just did your chapter 1 and we just did these, we'll go ahead and skip 2-5, which I normally do. But the one thing I want to, you know what I want to do first? We'll come back to 2-5. Let's go to 2-7. And we're just going to say whether or not this was a transaction or not. Do we consider this a transaction? So we got 6 questions. Let's take a look. All right, so we want to know whether or not it's a recordable transaction. So Toro purchased robotic manufacturing equipment that it paid for by signing a note payable. Is that a transaction?
I'll play yes.
Yes, that is a transaction. Whoops. All right. The next one, Toro's president purchased stock in another company for his own portfolio. No, right.
No.
Good job. The company lent $550 to an employee.
Yep.
Yes. Toro ordered supplies from Office Max that's going to be delivered next week.
Yes. No.
No. They ordered them, but they haven't got them yet, and they didn't mention. Right, they haven't, they just ordered them, they didn't get them, and they didn't say they paid for them. Yep, 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 yep. All right, I know that one was tricky. 6 investors in Toro sold their stock to another investor. No. And then the company borrowed $2.5 million from the bank.
Yep.
Yes. All right. So that's just a real thing to kind of keep in the back of your head, to always make sure that what we're working on is actually a transaction, because that will kind of get thrown at you once in a while. And the next thing I'm going to kind of just draw, and we'll go through it on the slides a little differently. So we have our assets equals liabilities plus stockholders' equity. And we've kind of mentioned we have common stock and retained earnings underneath here. And what we're now going to talk about, we talked about increases and decreases, but now we're going to start talking about our increases and decreases in the forms of debits and credits. And so assets, and we're always going to have this line down the middle. And then regardless of what side of that line you're on, debits are always going to be on your left and credits are always going to be on your right. But on the left side, a debit is going to increase your account, and a credit is going to decrease it. Right? So if you have cash and it's going up, it's going to be a debit. So therefore, you want your assets to carry a debit balance because you want cash to have a positive balance. On the right side of the equation, credits carry a debit or increase with a debit and decrease. I just said that backwards. Increase with a credit, decrease with a debit. Therefore, you want them to have a credit balance. Now, that is the rule 95% of the time, because we will introduce, and we'll talk about it next week, what we call a contra asset, which means it will carry the opposite balance. And we will have some that will go underneath here, and we'll talk about they go underneath retained earnings. Revenue, expenses, and dividends. Revenue carries the same balance. Debit decreases and credit increases. But debit increases expenses and it increases dividends. And if you think about that, if retained earnings carries a credit balance, and that's a positive thing, and revenue and expenses and dividends all carry into retained earnings, which they do. Revenue is a positive thing, but expenses and dividends decrease the total amount of retained earnings. The only way it's going to decrease those balances is if they carry the opposite balance. So everything on the right side, with very few exceptions, expenses and dividends are two of those. On the left side, debits increase assets until we talk 95% of the time. The other thing that I want to show you here, before we go back to the slides, is that the assets we've talked about so far, we've talked about cash, supplies, we've talked about property. We've talked about property, equipment. We've even talked about a logo. All right, cash and supplies are things that we call a current asset, CA. Property, plant, and equipment are what we call non-current assets. So anything that we won't use up in less than a year is a non-current or long-term asset. Anything that we could use up in less than a year is a current asset. Same thing for liabilities. Accounts payable, wages payable, those are current liabilities. Notes payable is a non-current liability. Notes payable is typically longer than a year. Accounts payable, wages payable, those would be things that we would pay in less than a year. So current is less than 1 year. All right. Non-current is greater than 1 year. All right, now I know I might have wrote that too fast. I'm not sure, so you guys tell me if you have that.
Yes. I don't see it.
What did we have it as? Was it CL or NCL? CL, yep. Mainly, even though it's a notes payable, it had that written after it. So for a notes payable not to be long-term, it will either specifically say short-term or it will say the number of months. All right, and what balance does it carry?
I said debit.
You put debit? Okay.
Yeah.
This one should be credit. Remember, we got assets, liabilities. On this side, most of the time it's going to be credit. Most of the time it's going to be debit. Most of the time. All right, what about common stock? SE. And it's going to carry a
Debit. Or wait, hold on.
Credit.
Oh, that's right, yeah.
Yep, credit. Yep. Okay. Now we got notes payable long term.
Now is it? That's non-current liability.
Now it's non-current liability, and it's going to have a credit. Income tax payable.
I put CL.
You are right, because when does the government want its money? Now.
Every year.
They want, right? Yep, exactly. All right, is it a debit or credit?
Credit.
Credit. All right, equipment.
But wait, why wouldn't income tax payable be a debit? Isn't it you're paying it out?
Right, but it's a liability, so it's going to be over here. Oh, that's all right. All right, what about equipment?
I did CL.
CL? What else we have?
NCA.
NCA. Equipment's an asset. So it'd be a non-current asset because that's something we're going to have for a long time, we hope. All right. Is it going to be a debit or credit?
Debit.
Debit, yeah. All right. What about retained earnings?
That's stockholder equity.
Yeah. And it's going to carry a
Credit?
credit. All right. Accounts payable.
CL.
CL. Yep. Current liability because we owe somebody. So that one's accounts payables liability, accounts receivables asset. And it's going to be a credit. And then cash.
Current asset.
Current asset. And it's going to be a debit. Yeah. All right. So that one, obviously, we just talked about. We just did it, right? So in your homework, you're going to find you have lots of these to do, okay? So you want to see how you're doing on these and base how well you're getting to understand these when you're doing your homework. I definitely don't recommend that you do your homework. See, the quizzes are due on Sunday night and your homework's due on Tuesday night. Don't do it on Tuesday night. Unless you're just breezing through all these questions, don't do it on Tuesday night. All right. So now we'll go back to the PowerPoint. So the next thing that we do is we actually take what we just did and we put it into journal entries. Now what I wrote out for you guys is now in a prettier format. So here's our assets, liabilities, and stockholders' equity showing you the normal balances that we just talked about. Debits, credits, and that we should have them on what side. And then they give you 3 important rules that you want to follow. All right. We'll just list them all at the same time. There we go. All right. So accounts increase on the same side as that they appear. So the assets are on the left side of the line. That's the side that increases them. A debits on the left side, they increase their liabilities and stockholders' equity on the right side of the line. They increase on that side. Debit's always on the left, credits are always on the right. The normal balance for the account is the side at which it increases. All right, so 3 things that should hopefully help you remember those. This is what we're going to be doing, journal entries that look such. This, instead of doing the increase and decrease, and if you had applied accounting, this is what you ended with. These are what we're going to be doing in here. Come on, there we go. Trying to get through that so we can do it. Okay, so for example, this was the very first one that we did, and we said we increased cash and we increased common stock. So I'll do this for the first one, and then we'll just look at what they have. And you can abbreviate, but for the first one I won't. This would be our journal entry. Cash, which is a debit. We typically write the debit first, and we indent it a little bit. And then we write common stock, and second line, and that's the credit. If you were writing it, which you'll see in some of our working papers, you'd have headings that would say debit and credit. And then you'd have columns that would look like that. So cash is a debit, common stock is a credit. We're increasing cash and we're increasing common stock. Make that go away. You'll see it again, so don't worry if you didn't write down. This middle part is what we just did. This is the step we did before at the very beginning. And this summarize here really isn't necessary. That's doing T accounts. And the only time we'll do T accounts is in chapter 8. Otherwise, I will always, if we need them for something, I always give you the solution in your working papers. Otherwise, we don't necessarily lose them. They're a teaching tool. This is the focus right now in what we're doing. Cash and common stock. So if we go to the next one, we paid $300 cash to do the logo. All right, we're going to debit logo and credit cash. So debit the logo and credit cash. We increased it before and we decreased cash. And the plus A, minus A just tells you your increase in asset and you're decreasing an asset. We borrowed $20,000 from the bank and deposited those funds and signed a formal agreement to pay. So who knows what account we're going to debit and what account we're going to credit?
Cash, right?
We're going to what to cash?
Debit.
Debit cash, yep, and we're going to credit?
Liabilities.
Yep. Do you know what liability?
Notes payable.
Yep, there we go. We're going to debit cash and credit notes payable. And then notice the T accounts are just to summarize. They just keep going up. They keep a total. So here we purchased the computers. In exchange, we promised to pay at the end of the month. So we debit computers or equipment, and we credit accounts payable. Increase equipment, increase accounts payable. All right, this one's a little trickier. Who knows what we do? We paid $5,000 to the supplier in D. What are we going to debit? What are we going to credit?
Credit accounts receivable.
Okay.
And debit accounts payable.
Okay, you got the debit accounts payable right. So hang on. Whoops. Oh, I just showed the answer. Let me see if I can get it off there. Okay. Yeah. You debit accounts payable. That's right, because we're taking it away from accounts payable. But what's this say?
Taking it out our cash.
There we go. Yep. And just a little hint, you're never going to use accounts payable and accounts receivable in the same journal entry. Because one of them talks about getting cash and one of them talks about paying cash. All right, but you had the right idea, and a lot of times there's a lot of confusion between accounts payable and accounts receivable. But this is right. So you guys got there. And that was a hard one considering you don't have the other information right in front of you. All right, what about ordered software, signed a contract, but no game and no code? Are we going to debit or credit anything?
No.
Nope. So it's still nothing. And then when we receive it, this is what this one looks like. So remember, we had 3 different things happening, so we're going to have 3 different things happen in the journal entry. We are going to debit the software because that is increasing. We're going to credit cash because we were paying $4,000, and we're also going to credit accounts payable because we owe the other $5,000. So 3 different things are going on in that one. And then the last one, we received supplies on account. When we're all done with it, it looks like this on the right, and that would be what we call our general ledger, where you can always go in and see what our total is. You can always see the total in each account. The general journal, which is on the left, that just tells us everything that happened on a day, but it doesn't tell us how much is in accounts payable or how much is in equipment. All right, so let's go back and look at a working paper and work a problem here. So let's scroll down to, or you're not scrolling, you're flipping. Let's do this one, E24. It's on page 6. It is 5 journal entries. And then when you're done, let's go ahead and raise our hands. That way I can know that you guys are done. Thomas, are you done already? Oh, okay.
My hand was already up.
Oh, okay. Thank you.